Have you ever dreamed of having an extra $1,000 per month solely as passive income? Have you ever considered that dividends could get you there? Having $1,000 a month in passive income from dividends might be your first investment milestone whenever thinking about getting into dividend investing. Why is this important, you may ask? Well, it's not a bad amount, but $1,000 in most places in the world is not enough to live comfortably on. So, it's not like this amount is going to achieve your total financial independence or enable you to quit your job outright. However, think about how good it would be to have an extra $1,000 a month that you didn't have to work for. Your money would be working for you and earning you a good portion of your monthly expenses. $1,000 in passive dividend income is a good goal to work towards whenever you're starting investing, since it's not so far out of reach as to be completely discouraging, and not so close that you won't feel a well-earned sense of accomplishment whenever you do reach it. What should you invest in, and how much should you invest to be able to reach your goal of $1,000 a month in dividend income? Well, let's look at these questions one at a time, since the answer to this one depends on the answer to the other.
Crazy markets. That's what we've had the last few days. So how did you handle it? Were you looking for a bug out bag, or were you realizing, hey, maybe this is an opportunity?
Do you find the stock market intimidating? Many investors do, and this question is one of the first ones that you'll have to ask yourself. What stocks should I invest in? The answer to this question will depend heavily upon your stage of life as well as your personal preferences. Younger people who have more time to invest will make different investment decisions than someone who is much older and much wiser who may want the money sooner for retirement. Everyone's risk tolerance level is also different, and some people will be less willing to make risky stock purchases for the chance of a higher dividend level. Let's look at the different types of stocks that are out there and see how each kind could serve your investment needs. First of all, we're going to make a decision between value investing and dividend investing. Both can produce dividends, but in different amounts. So some companies do in fact have much higher dividend yields, but it's not always the best choice for you. Stick with me for a minute and you'll see why.
As a more aggressive kind of dividend investor, I'm always on the lookout for high-yielding dividend stocks and ETFs that'll pay me the most in passive income while balancing the risks involved with holding these particular funds.
The top rules of high dividend stock investing. Investing in high dividend stocks will net you faster dividend payouts sooner on your investing journey. Some companies, such as Verizon or General Mills, do offer a much higher dividend payout, up to 4%, whenever the market average for a dividend payout is 3%. Some companies, like ExxonMobil, might even have higher dividend percentages, closer to 9 or 10%. However, it can actually be quite risky to have a high-yield dividend. Either the company is paying out a high percentage, or worse, all of its earnings and dividends, and therefore compromise the future of company growth and overall stock value. Or it could just be that the price per share of the company's stock is falling, which makes the dividend payout ratio appear higher than it used to be. Either scenario could be dangerous whenever you're talking about long-term health of your investments, so choose wisely and always do your research whenever deciding upon a high-yield dividend stock.
If you struggle with the motivation to invest, I'd suggest you try a more income-seeking approach to investing. You might get really addicted to all of that money being paid out to you.
A safer choice for the dividend higher investor would also be an ETF or exchange-traded fund of a reliable dividend-producing stock within the Dow Jones stock market. The Dow Jones Dividend US 100 Index, which includes dividend-paying companies like Verizon, 3M, and even McDonald's, combines and averages the mix of each of the individual stocks within the index so as to return a steady 3% overall return for the investor. The majority of large dividend-paying companies, including the ones listed, help to pay quarterly dividends. Having this mix of divided yield stocks helps to reduce the average risk to you, the investor. Even if the performance of one stock goes down, it's still balanced out by the other stocks in the ETF mix to still give you the returns that you need. So that's basically dividend investing. This is the money that you'll earn in dividends, which is generally to compensate for the fact that, as a well-established company, you're not going to see as much growth in the value of the stock itself. Now, let's take a real quick transition and look at the other side of the coin, which is stock investing, including investing in stock growth.
You see, growth investors are trying to invest in those companies that are growing faster than the market in a bid to earn higher than average returns.
Are high-growth stocks a good alternative? Growth stocks are stocks in publicly traded companies which are expected to grow rapidly. Instead of sharing its profits with its investors by paying out a steady dividend, the company reinvests its retained earnings into the company so as to generate future growth and value. Now, it may have a small dividend, such as the one that might be less than 1% of the stock price, but here's the kicker. Most of the value that you would earn investing in growth in stocks is the appreciation in value of said stock as the company grows and becomes more valuable. Some well-known growth stocks are Apple, Alphabet, and Tesla. Apple, for example, does pay a dividend, but its yearly yield is only 0.6%. Clearly, if you were to be only concerned about your dividend returns, this would not be a good return on your money. However, unlike dividend stocks, where you realize some of the value of your stock every payout, you're not really going to realize the value of your stock growth, at least until the time in the future whenever you sell that stock and realize your capital gains. Growth stocks are therefore better for long-term investors who may wait years or even decades to realize their future returns, even if they're making some small dividend earnings along the way. A large cap growth index fund, which does include some of the large growth companies out there, Vanguard Growth Index Admiral for instance, includes Apple, Microsoft, and Amazon as its top 3 holdings. Here, the total dividend yield is only 0.58% over its entire portfolio, showing that its mainly priority is trying to get long-term value growth rather than immediate cash value in form of dividends. Consider that with these very large and very successful tech companies, you are more than likely to achieve more long-term value growth with the stock value than your dividend value would earn you if you were to invest solely in dividend stocks. Combining the long-term share growth with the small dividends can end up getting you farther in the long run, opting for dividend yields alone.
So first of all, let's clear up a misconception because dividend-paying stocks and growth stocks, it's not like they're completely different companies. They're all just companies that offer stock.
The mixed approach. We get it. You're totally busy. So if you're somebody who doesn't want to put in the hours of obsessive amounts of research on different stocks and investing strategies, then a good and pretty much safe option can simply be put as buying the market. A good quality index fund that simply tracks the performance of the S&P 500, such as the Fidelity 500 Index Fund, helps to give you some stock growths through Apple, Tesla, and Facebook, along with higher dividend yield stocks like Nvidia. This overall index fund currently has a dividend yield of around 1.5%, which is a much lower dividend than a dividend index would have, but also a substantially higher one than a growth portfolio would normally give you. The riskiest strategy for dividend investing is buying individual stocks from a specific dividend-paying company. I mean, sure, you might get some really great returns for a while, but it's also important to understand why a company is paying a high dividend relative to its share price. It could be that the normally high share price is temporarily deflated, or maybe it's that the value of the stock is on its way out and down. There's also the fact that it could be that the company is all fixed size and unlikely to show further growth down the road. Another possibility is that it could be that the company is in an exceptionally volatile industry and is compensating its investors for the high risk by giving them a much higher return. To be able to start this kind of investing, you need to be able to hop onto a good finance website and do your due diligence in researching to know more about each company and help yourself to understand the reasons behind its unusual high dividend yield before attempting to build a dividend portfolio of individual stocks. Let's get back to our second question though. How much do you need to invest to get that $1,000 in dividend income? Well, depending upon your investment strategy and of course rate of return, you'll more than likely need various amounts. A strategy of investing in high-growth stocks like Apple at 0.6% dividend would require you to have almost $2 million invested so as to receive $1,000 in dividend income. A mixed strategy of growth and dividend stocks, such as good index funds, will help you get a return of about 1.5%. So, in that case, you need to have at least $1 million invested for a $1,000 monthly dividend. On the other hand, a high dividend stock such as Verizon with a payout of 4% will require you to only have about $350,000 invested so as to get a return of $1,000 a month. And if you take a much riskier strategy by investing in a very high stock like Exxon, which gives you 9% returns, you would theoretically only have to put in around $200,000 to earn that $1,000 a month.
If you want to take on more risk, you can choose a selection of more growth stocks than dividend stocks in your portfolio, and vice versa. If you're less risky, you want to choose more index funds, ETFs, and dividend-paying stocks.
Playing the game to win. We all want to be able to win. Dividend investing, by nature of the amount of money involved, is going to be playing a long game. The average Joe doesn't have $500,000 just lying around willy-nilly to invest in dividends so as to jumpstart his journey to $1,000 in dividend income. A younger person will be more than likely to take a more growth stock-oriented view, as they have much more time to accumulate stock value and leave dividends until the final approach of retirement. An older person who may already have a nest egg built up or who might have inherited some money might be more interested in investing in a dividend ETF right away, in order to have the stable income that a well-established dividend can provide. So, what is going to be your path to $1,000 in dividend income? Strategically speaking, probably the best path for you would be a strong mix of growth stocks for the greatest overall portfolio value, with some stable dividend stocks to provide some immediate return, either for immediate income or investment in your portfolio. It's also possible for a younger person to start on this path to great higher growth stability and gradually shift their investment holdings into a much more dividend-rich strategy 20 or even 30 years down the road whenever they approach that retirement age. With the combined powers of reinvested dividends, compound interest, and even stock price appreciation, you may get your financial goals sooner than you think.